On June 24th of this year, the world's largest bank by total assets made an announcement that almost nobody outside of China noticed. The Industrial and Commercial Bank of China, $7.6 trillion in assets, larger than most countries' entire economies, permanently shutting off retail gold and silver trading. July 24th, 1 month away. It was not alone. Postal Savings Bank of China did it first, back in February. Then Ping An Bank in March. Then China Guangfa Bank in June. One after another, China's largest financial institutions, combined assets exceeding $10 trillion, all pulling the plug on the exact same product in the exact same window, weeks apart. I want to show you two versions of this story, because the difference between them is the entire video. Version 1 is the official version. Version 2 is the one that should genuinely unsettle you if you are holding physical metal right now. By the end of this video, I'm going to show you the evidence for both, honestly, without choosing the dramatic version over the accurate one. And I'm going to show you a $1 trillion accounting gap sitting quietly inside America's own books that almost nobody has noticed. Stay with me, because the number you're going to hear before this video ends changes how you think about the gold sitting in your own safe. Chapter 1. Two versions of the same story. Version 1. The official version. China says this is simple risk management. Gold crashed nearly 30% from its January peak. Leveraged retail traders were getting hurt. Margin requirements spiked to a record 140%. The government stepped in to protect people from themselves. That's version 1. Version 2. China is not protecting its citizens. China is clearing the table, getting rid of every paper claim, every leveraged bet, every fake ounce of gold that exists only on a screen, so that what is left when the dust settles is real metal trading against real demand, for the first time in 50 years. By the end of this video, I'm going to show you the documented evidence for both, not the version that makes the best headline, the version the data actually supports. But before we can evaluate either version, you need to understand exactly what paper gold actually is. And the clearest way I know to explain it is with something every coin collector already understands. Chapter 2. The coin in the safe. Imagine you own one genuine, rare 1904 Morgan silver dollar. One coin. In your safe. You can hold it, weigh it, photograph it. There is exactly one of it in existence in your possession. Now, imagine you write a paper certificate. This certificate entitles the bearer to one 1904 Morgan silver dollar held in trust. You sell it to someone for cash. They're happy. They own a claim on a real rare coin without the hassle of storing it themselves. They never come to collect it. Why would they? Here's the problem. Once you realize the buyer is never actually going to show up and demand the physical coin, what stops you from printing a second certificate, a third, a 10th? Now there are 10 people who each believe they own that exact coin. There is still only one coin. On paper, the supply shows 10 coins. In reality, 1. The moment everyone with the certificate shows up on the same day and asks for their coin, the entire system collapses. Because 9 out of 10 people discover their paper is worth exactly nothing. That is the simplified version of paper gold. And here's the uncomfortable part. In the major Western gold markets, London's bullion market and the COMEX Futures Exchange in New York, the overwhelming majority of gold that trades every single day is never physically delivered. It exists as contracts, claims, pieces of paper representing a right to gold that almost nobody actually intends to collect. Nobody knows the exact ratio. That is precisely the point. But the structural conclusion follows directly from the mechanism itself. If there is meaningfully more paper than physical, the price the paper market produces is almost certainly lower than what the physical metal would be worth if priced on real scarcity alone. That's the theory. Now let me show you the actual evidence. Because a theory is not proof, and you deserve proof before you change how you think about anything. Chapter 3. 3 pieces of evidence. Here's how you would actually know if this theory were true, rather than just plausible. 3 pieces of evidence. all documented, all dated, all sourced. First, you would expect to see a price gap between the physical metal and the paper claims on it. If the system were completely honest, the two prices would trade essentially 1-to-1. The moment that ratio becomes uncertain, buyers start paying a premium for the real thing. Has this actually happened? Yes. In January this year, the physical-to-paper spread in silver hit approximately 40% at its peak. A genuine, documented divergence between what physical silver actually cost and what the paper futures price claimed it should cost. That spread has narrowed since, but it has never fully closed. Second, behavior. If you genuinely believe the paper market was understating gold's true value, what would you actually do with your own money? You would sell the paper claims, buy the physical metal. Is anyone with serious resources actually doing that? Yes. And the institutions doing it are not retail speculators. They are the most sophisticated money managers on the entire planet. The institutions that literally print the paper currencies. Central banks. Central banks bought a net 244 tons of gold in the first quarter of this year alone, the strongest first quarter ever recorded in the modern data series. And this is not a one-time spike. They have purchased over 200 tons in 10 of the last 11 quarters. A sustained, multi-year accumulation pattern, not a panic trade. And here's the detail that should genuinely concern you. According to the World Gold Council's own published methodology, their official buying figures explicitly include an estimate for undisclosed purchases. Gold that central banks are buying, but choosing not to officially report. The publicly disclosed numbers are, by their own admission, a floor, not a ceiling. Third, and this is the half almost no mainstream coverage connects properly, what are they selling to fund that buying? U.S. Treasuries. For roughly 50 years, the standard strategy for every central bank was simple. Take your surplus dollars, park them in U.S. Treasury bonds, sleep soundly. That strategy is now visibly reversing. China alone has reduced its treasury position by hundreds of billions of dollars over the past decade, rotating a meaningful share of that capital into gold. The direction is unambiguous, and it has held steady for over a decade. Think about what that trade actually represents. Selling a paper promise from the most powerful government on earth in order to buy a metal that pays you nothing. On paper, that sounds economically irrational. You would only make that trade if you no longer fully trusted the promise behind the paper. 10-minute reset bomb. Stop. Everything I've shown you so far, the paper gold system, the price spread, the central bank buying pattern, the treasuries selling, that's the diagnosis. What I'm about to show you is the plan. Based on official government data, China told the world directly 12 years ago at the exact institution it was warning. If you've stayed this long, what comes next is the evidence that makes everything else make sense. Chapter 4. The Speech That Was a Plan. In 2014, the head of the Shanghai Gold Exchange stood up at a conference hosted by the London Bullion Market Association, the Western institution that has effectively set the global paper price of gold for decades, and said almost word for word, when China earns the right to speak in the international gold market, gold's true price will finally be revealed. That was 12 years before this video. At the time, it read as ambition. Today, in 2026, it reads as a plan that has been executing on schedule the entire time. Here's how the two pieces fit together. Because they were never separate decisions. They are two halves of a single coordinated system. Half 1. Shanghai. The Shanghai Gold Exchange is built fundamentally differently from London's market. It is a physical delivery exchange. When metal trades there, actual metal has to move. There is no equivalent of the unlimited certificate printing problem. The system is structurally designed around real bars changing real custody. That produces what economists call genuine price discovery, a price that reflects actual supply and actual demand, rather than a price diluted by an unknown multiple of paper claims layered on top. Half 2. Hong Kong. a new gold clearing and settlement system built specifically to be the front door international capital can walk through to reach Shanghai's physically backed pricing, without running into mainland China's currency restrictions. Hong Kong is expanding its physical vault capacity roughly tenfold, from approximately 200 tons of storage toward a target north of 2,000 tons. Sit with that number. You do not build a vault 10 times larger than your current need for a paper casino. You build a vault that size when you intend to actually hold the metal that settles real physical trades, not unlimited claims on metal that may or may not exist. Put Shanghai's physically backed price discovery together with Hong Kong's role as the international access point, and what you have is a complete parallel financial architecture, sitting entirely outside London, entirely outside New York, and entirely outside the dollar's traditional control over how gold gets priced for the rest of the planet. Chapter 5. The Honest Version. I want to stop here and give you the version of this story the conspiracy framing conveniently leaves out, because you deserve the complete picture, not just the dramatic half. The retail trading shutdown did not begin this month. It began in 2020. After an incident known inside China's banking industry as the crude oil treasure crisis, when a Bank of China product linked to oil futures imploded the day oil prices briefly went negative, leaving ordinary retail investors owing money they never imagined they could lose. China's regulators have been incrementally tightening retail commodity speculation ever since, freezing new account openings as early as late 2020, years before this year's gold crash even happened. This year's shutdown is the final chapter of a 6-year regulatory arc, not a sudden new conspiracy invented in June, and the approximate trigger is genuinely verifiable. Gold fell from a January peak near $5,600 to below $4,000 by June, a drawdown of nearly 30% in roughly 5 months. That is precisely the kind of violent move that historically blows up leveraged retail accounts. And here's what's critical to understand. Physical gold ownership in China remains completely untouched. You can still buy bars, coins, and jewelry freely. Institutional trading channels on the Shanghai Gold Exchange remain fully open. What is being eliminated specifically is the leveraged deferred settlement layer, the part of the market that behaves most like a casino and least like ownership. So here is the honest synthesis. Both things can be true at once. China's regulators have a genuine, well-documented, multi-year history of de-risking exactly this kind of retail leverage. And this year's gold volatility gave them the final justification to finish a process already years in motion. At the very same time, the infrastructure China is simultaneously building in Shanghai and Hong Kong is real, well-funded, and structurally designed to challenge how gold gets priced globally, regardless of what specifically motivated the retail shutdown's exact timing this month. The honest version is actually the more durable one. Chapter 6. The Trillion-Dollar Gap. Here's a fact that sounds invented, but is completely real, sitting in plain sight in official government records. The United States government officially holds approximately 8,133 tons of gold. On the government's own books, that gold is not valued anywhere near its actual market price. It is valued at a price fixed by law back in 1973 and never updated since. $42 per ounce. Gold today trades around $4,000 an ounce, which means officially, on paper, the United States values its entire national gold reserve at roughly $11 billion. At today's actual market price, that same gold would be worth somewhere close to $1 trillion. A trillion-dollar gap, hidden in plain sight. Inside an accounting rule nobody has touched since the Nixon administration. Here's why that gap matters enormously right now. With the stroke of a pen, a legal revaluation, updating that official price from $42 to something closer to market value, more than $1 trillion in recognized asset value would instantly appear on the Treasury's own balance sheet. Real, usable value. Created without issuing a single new bond, without asking Congress for a single new dollar of borrowing authority. This is not fringe speculation. The Federal Reserve has itself published research examining exactly this mechanism. Treasury officials have publicly discussed, in their own words, monetizing the asset side of America's balance sheet. There is also a separate, well-documented proposal for a 50-year Treasury bond redeemable in either dollars or physical gold at the holder's choice, which would functionally partially back a portion of America's debt with real gold. For the first time since the gold window closed in 1971, that is structurally the exact same strategy China is executing with the yuan, mirrored on the American side of the ledger. If China anchors its currency's credibility to gold, the documented American countermove under serious internal discussion is to do precisely the same thing for the dollar. Chapter 7. The quiet version. Even if every single piece of speculation above turns out to be wrong, even if no formal gold revaluation ever happens at all, gold does not actually have to go up in price for this entire dynamic to play out in your favor as a physical holder. The dollar simply has to go down, and the practical result is identical. If the value of the dollar erodes through ordinary, unglamorous inflation, even without any dramatic gold revaluation, the purchasing power relationship between your physical metal and your paper currency shifts in exactly the same direction. The metal does not need a press conference to become worth more in real terms. It only needs the currency it is priced against to continue losing ground, the way it already has by roughly 30% in cumulative purchasing power over just the last 6 years. That is the quiet version of the story, less cinematic than a formal gold-backed bond announcement, considerably more likely to actually be the path this takes. So here is what to actually watch. July 24th, the date the last major Chinese retail paper gold channel goes dark for good. What the Hong Kong settlement system does in the months that follow once that vault capacity comes fully online, and whether any version of an American gold revaluation moves from quiet internal discussion into an actual public announcement. The paper system spent 50 years telling the world what gold was worth. For the first time since 1971, the physical market may finally get the chance to answer back. The silent outro. None of this requires you to believe in a hidden global conspiracy. Every single piece of it is documented, dated, and sourced. What it requires is recognizing that two of the largest economic powers on Earth appear to be independently arriving at the same structural conclusion at the same moment. That the 50-year-old system of paper promises and leveraged claims is being quietly, deliberately replaced by something that requires real metal to actually move. Here's what I genuinely want to know from you. If you are holding physical gold or silver right now, drop in the comments whether you hold it inside the dollar-based Western system or whether you hold it fully outside any banking system in your own physical possession. I'm building a follow-up video specifically comparing the practical realities of both approaches, and I want real answers from people actually holding the metal, not hypotheticals. Here's what's coming next. This video laid out the structural case, what China shut down, what it's building, and what America might do in response. The next breakdown goes deeper into the mechanics of the Hong Kong settlement system specifically, what its vault expansion means for price discovery in real numbers, and what the timeline looks like for when it becomes a genuine alternative benchmark. Subscribers get it first. Subscribe. Hit the bell. Because July 24th is the date the last paper door closes. And what happens on the other side of that door, in the physical market, is the story worth watching.